Warren Buffett's calm mind during market chaos, the psychology that made him billions. Have you ever noticed something strange? When the stock market crashes, headlines scream panic, social media fills with fear, and millions of investors rush to sell. Yet one man often becomes even calmer during the chaos: Warren Buffett. Why? The answer has very little to do with intelligence and almost everything to do with psychology. Today, we're stepping inside Buffett's mindset to uncover how emotional discipline, not prediction, has become one of the greatest investment advantages in history. By the end of this episode, you'll see market volatility in a completely different light. Imagine walking into your favorite grocery store. One morning, everything is suddenly 30% off. Would you panic and run out of the store? Probably not. You'd likely fill your cart with things you already wanted. Yet when great companies suddenly become cheaper during a market correction, many investors do the exact opposite. They sell. This is where human psychology takes over. Our brains are wired for survival, not investing. When prices fall sharply, the emotional part of the brain interprets the drop as danger. Fear spreads faster than logic. We begin copying everyone else because, throughout human history, following the crowd often meant staying alive. But investing rewards a very different behavior. Warren Buffett has spent decades training himself to separate price from value. A falling stock price doesn't automatically mean a business has become worse. Sometimes it simply means emotions have temporarily overwhelmed rational thinking. One of Buffett's greatest strengths isn't predicting the future, it's refusing to let fear make his decisions. Think back to some of history's biggest market downturns, whether it was the financial crisis of 2008 or the sharp sell-offs during the COVID-19 pandemic. Markets eventually recovered. Companies that continued creating real value rewarded patient investors, while panic selling often locked in permanent losses. That's why Buffett famously reminds investors to be fearful when others are greedy, and greedy when others are fearful. It's a simple sentence, but incredibly difficult to live by. So how can you build that same calm mindset? First, create your investing rules before emotions arrive. Decide in advance why you're buying an investment and under what conditions you'd sell. Second, stop checking your portfolio every hour. Constant monitoring amplifies emotional reactions without improving long-term results. Third, focus on owning excellent businesses rather than chasing stock prices. When you think like a business owner instead of a trader, short-term volatility becomes far less frightening. Finally, remember that patience isn't passive. It's an active decision to trust sound research over temporary emotions. The market will always have moments of chaos. There will always be headlines predicting disaster and voices encouraging havoc. But history consistently rewards those who remain rational when everyone else loses control. Warren Buffett's greatest investment secret isn't hidden inside complicated financial models. It's the quiet ability to stay calm when others are overwhelmed by fear. If this episode changed the way you think about investing, don't keep it to yourself. Like this video, subscribe for more insights into the psychology of investing, and share it with someone who could use a calmer perspective the next time the market gets turbulent. Until next time, remember, the strongest portfolio begins with the strongest mindset.